It's your boy, Young Equity Chris.
It's your boy, Young Equity Devin. Let's get it.
All right. Today we're going to be talking about Affirm. So this stock is a stock for a e-commerce online, financing company. So basically, when you online shop at certain websites, primarily I think about GOAT. It's a sneaker resale app. You can basically put on a payment plan. So if you don't have the whole $600 for your Yeezys today, you can maybe put a little bit down to pay a little bit on it every month, so you can have those shoes as soon as possible. Honestly, it gives people, consumers more access to the products they want, but I think it's another debt building tool, and I don't like that. But I'll take my feelings aside, and I'll just let Devin talk about the stock.
Yeah, man. So let's go through the financials right now. So total revenue for 2019, $264 million. That's pretty decent for a small company, especially for the services that they offer. 2020, $477.62 million. So almost 100% increase on that. Let's look at their net income. Net income for 2020 was a negative number, negative 112 million. That's not good, but I think maybe they're trying to figure it out. Plus, it was during that time period where people were having some issues with their business. So 2020 was a very rough year for a lot of folks. So let's not discredit them for that. Total assets, let's go to the balance sheet, right? Balance sheet is total assets minus your total liabilities. All right, so 2019, they had $1.1 billion in assets and 600,000 in liabilities. Now that's above where I feel like the threshold should be. You want to be around the 38% range, and they are over that for sure. For 2020, their debt to income ratio actually, or their total asset and liability ratio actually went up. So it increased, which is not great. So that means that they're either owing some folks or they're not making enough money. So that was 1.4 billion in total assets, and then 965 million, so almost $1 billion in liabilities, which is not so great. But they did just beat earnings, and they have a very good earnings report. Total revenue as of right now for Q3 was 214 million, which is very good compared to where they were last year.
Okay. So with Affirm being at about $123 a share, this is my personal take on the matter. I think especially with a looming correction, this is a stock that can definitely be affected, because usually high debt companies are the ones who get destroyed by corrections. So at $120, it's a little bit expensive for me. It just had a 30% surge here recently. So personally, it is not a buy zone, nowhere near a buy zone for me. I'll give you the price I think you should get it at. I say below $90 a share, but you'll be waiting a while for it to do that as well. So it's a hard pass for me.
Yeah, where I'm at with it in the past month has been going crazy. So it's up $57, which is around 90%. Anytime it's up 90%, I'm going to stay away. I'll look at it when it's around, like Chris said, $90 to $80. I mean, as of right now, there's really not a lot of room to grow. I think it's kind of one of those stocks where people are getting into it and there's a lot of volume. There's really not a lot of technical analysis behind it. And then with that correction coming, there's definitely going to be 25 to 50% market correction on this particular stock. So get in whenever, I wouldn't say probably in a couple weeks, 3 weeks, definitely get in on this one. It's going to rise back up.
All right. But again, I'm no financial advisor.
And I'm not an expert.
Thank you guys for watching the video. It's your boy, Young Equity Chris.
It's your boy, Young Equity Devin. Let's get it.